The dot-com bubble marked a technological gold rush, drawing investors and entrepreneurs alike to the burgeoning internet sector. Envisioned as a transformative era, it promised unprecedented growth and opportunities, igniting a frenzy of speculative investment in anything web-related. The advent of the internet heralded new possibilities, connecting the world in ways never before imagined. Its early promise of global communication, access to information, and digital commerce captivated visionaries and ordinary users, setting the stage for a tech-driven future. As stories of rapid success and immense profit from internet ventures spread, a wave of investment in tech startups began. Investors, eager to capitalize on the next big thing, poured money into companies with the dot-com suffix, expecting substantial returns. Venture capital played a pivotal role in fueling the bubble, with firms aggressively funding startups in hopes of striking gold. This influx of capital enabled many young companies to grow rapidly, despite lacking sustainable business models or revenue streams. Key players emerged, defining the dot-com era with their innovative approaches and market dominance. Companies like Amazon and eBay became household names, embodying the potential of e-commerce and altering the landscape of retail and business forever. The IPO craze marked an era where startups transitioned into public companies overnight. This rapid shift promised vast wealth, drawing in both seasoned and novice investors. Dreams of exponential growth overshadowed traditional financial wisdom, fueling a gold rush towards tech stocks. Media coverage played a pivotal role, magnifying investor excitement. Stories of instant millionaires and groundbreaking technologies dominated headlines, creating a self-reinforcing cycle. This hype not only attracted more investment into dot-com companies, but also propelled their valuations to unprecedented levels. The surge of e-commerce redefined retail, with businesses racing to establish online presences. Dot-com startups, promising to revolutionize shopping, received astronomical valuations. This new online business model, though flush with potential, often lacked the profitability to justify such investments. As the millennium approached, the Y2K scare spurred a technology spending spree. Companies and governments poured money into updating systems, inadvertently inflating the tech bubble. This fear-driven boost in IT investment further disconnected market valuations from the economic reality. Irrational exuberance reached its peak as investors ignored traditional valuation methods. The emphasis shifted from fundamentals to speculative growth potential. This detachment from reality signaled a dangerous bubble, setting the stage for an inevitable correction. As the dot-com bubble swelled, a chorus of skeptics began to emerge, questioning the sky-high valuations of internet companies with little to no profit. Their warnings highlighted the growing disconnect between the speculative fervor and the economic fundamentals underlying these businesses. The inevitable burst came as a shock to many, despite the clear signs of overvaluation. The rapid decline in stock prices led to a cascading effect, causing widespread financial distress. Investors saw fortunes vanish overnight, marking a pivotal moment of reckoning for the tech industry. In the aftermath, the landscape was littered with failed startups and bankrupt companies. Black Friday for dot-coms saw once celebrated businesses fold, unable to sustain operations without the influx of speculative capital that had dried up almost overnight. The global economy felt the repercussions of the bubble's burst, with market confidence shaken and investment capital becoming scarce. The fallout affected not just the tech sector, but also had a dampening effect on broader economic growth and innovation. However, from the ashes of this turmoil, some companies emerged stronger, having adapted to the new reality. They refocused on sustainable business models, cost control, and genuine value creation, laying the groundwork for the resilient tech industry of today. The aftermath of the dot-com bubble burst brought a wave of regulatory changes aimed at protecting investors. Authorities tightened securities laws and oversight, fostering a climate of caution. Investors became more vigilant, scrutinizing the fundamentals of tech startups more closely to avoid past mistakes. Surviving the dot-com crash required companies to adapt swiftly and efficiently. Those that remained focused on sustainable business models and cost control not only survived, but eventually thrived. This period of adaptation highlighted the importance of agility and a solid value proposition in the tech industry. The role of the dot-com bubble in shaping today's internet is undeniable. It accelerated the infrastructure and adoption of the web, laying the groundwork for the digital age. Despite the turmoil, the bubble period was a catalyst for innovation, pushing forward technologies that have become integral to modern life. The tech industry's recovery post-bubble was remarkable, showcasing its resilience and capacity for innovation. New and old tech firms alike learned from past overreach, focusing on building real value and sustainable business models. This period of reflection and recalibration set the stage for the robust growth that followed. The legacy of the dot-com era lives on in the innovations that endured and continue to define our digital landscape. From e-commerce giants to foundational internet technologies, these survivors have shaped how we live, work, and play online, embodying the enduring spirit of the dot-com dream. The cultural impact of the dot-com bubble on Silicon Valley was profound, transforming it into a symbol of innovation and entrepreneurship. This era fostered a unique blend of risk-taking and creativity that continues to influence tech culture and startups today. As a cautionary tale for future generations, the dot-com bubble serves as a reminder of the consequences of speculation and the importance of solid business fundamentals. It underscores the need for balance between innovation and financial sustainability in the ever-evolving tech landscape.